Although you should be married to most of your dividend-paying companies, selling them may make greater financial sense. This video discusses the 7 most typical dividend stock sell signals. Dividend growth investors seek equities with high dividend growth, yield, and consistency. This technique makes use of the double compound effect, where dividend increase and stock price appreciation affect returns. If something threatens this system, sell the shares, especially when multiple negative indicators are present. If your dividend-paying stock hasn't increased in a year or two, even without a market recession, sell it. Dividend investors expect yield and growth to rise. Investors can't maximize compounding if it's not rising. If dividend increases stop after a year or two, sell the stock regardless of the other signs. A corporation with heavy debt or poor financial management rarely raises dividends. This could lead to dividend suspension or decrease. Seeking Alpha's free version helps dividend investors examine dividend growth. Search for a company in their search box, click the Dividends tab, and choose Dividend Growth or Dividend History. From there, you may see dividend growth rates, dividend amounts, dividend frequency, and annual dividend growth. If a dividend-paying corporation decreases or suspends its payout, sell your shares immediately. No dividends, no compounding. The dividend growth investment strategy fails without dividend compounding. Sell your investment quickly if a firm cuts its payments, regardless of why. We don't want dividend-paying companies to cut dividends again. Dividend cuts can also indicate inadequate management, unmanageable debt, bankruptcy, or a failed business model. During recessions, dividend cuts are more prevalent. Thus, we should look for companies that maintain or grow their payout. Sell the dividend-paying stock if the dividend payout ratio changes by 10% or more in a short time. Others may think that a sudden payout ratio increase means greater dividends. It actually suggests a corporation may not be making enough profit and could be deceiving shareholders by paying larger dividends. Firms may dramatically drop their dividend payout ratio, which lowers future dividends. This is usually done to save money, reinvest, or buy back stock. We don't want this because companies with a lower dividend payout ratio don't pay dividend investors enough for retaining their stock. These firms may also be financially unstable. If this happens with a dividend-paying stock, investigate the payout ratio change. I'd sell a dividend-paying stock if you can't explain the change or if other measures threaten the dividend. The dividend payout ratio is calculated by dividing dividends by net income, or by dividing dividends per share by net income per share. The Dividend Safety tab on Seeking Alpha lets you assess this dividend payout ratio. Credit ratings are used to grade firms' finances. Rating agencies score firms, which helps investors choose companies with good credit. S&P, Moody's, Fitch, and Morningstar are the most popular rating agencies. Higher-rated corporations are less likely to crash or lose stock value, helping investors assess risk. Rating agencies assess these companies from AAA to D. Low ratings don't always equal higher danger. It strongly urges not investing in the company. It's not always high risk, high reward. A credit rating indicates a company's financial health and ability to repay loans, and also forecasts future stock price growth. Downgraded companies may pay more for new debt. To maintain cash flow and avoid credit rating downgrades, firms may postpone dividends. Hence, if a rating agency downgrades a dividend-paying company you own, you should research and consider selling the stock. High cash companies buy back a lot of shares and keep them, which reduces public share availability. This is especially true in low interest rate environments where corporations can issue more stock buybacks by issuing cheap corporate debt. When supply is low, demand rises. Demand may rise if the stock market has less shares of a company. The remaining firm shares would then be worth more. Dividend-paying firms suspending stock buybacks is the issue. When this happens, corporations usually lack the cash or debt to finance stock buybacks. A dividend cut is likely if a corporation cannot fund its stock buyback program. Until they're announced, stock buybacks are hard to trace. Companies may announce stock buybacks to shareholders. Quarterly financial statements can also show if a company's shares have decreased. As you know, dividend growth investment works best with a 4% or more starting yield. In many circumstances, a starting yield exceeding 7% indicates an advantageously priced dividend that is unsustainable, called a yield trap. Remember that rising share prices lower dividend yield ratios. Conversely, a dividend-paying company's share price falling raises its dividend yield. As a company's share price falls and its yield becomes more appealing, it may cut expenses, allocate funds, or even take on more debt and sell shares to support the dividends. This will lead to debt and bad cash management, forcing corporations to slash their dividend. To avoid this, monitor your dividend company's share price, direction, and dividend yield. Because of dividends and compounding, dividend investors disregard short-term stock price fluctuations. If one of your dividend-paying firms is underperforming and has a higher dividend yield, try to figure out why. A sharp stock price rise, which many dividend investors overlook, is the last key sign. Slight stock price movements that follow the market are usual. I mean stock price hikes of 10% or more in 2 or 3 days. In these circumstances, I sell some of my company stocks, maybe 15%. Stock prices often drop after a sharp rise. To capitalize on this rise, sell 15% of your stocks at the high price and buy back in when it levels out. Avoid stock timing and control your emotions. Since you sold some of your stocks and presumably have unrealized gains in your portfolio, you have nothing to lose even if the stock price stays high for a long time. Reinvest these gains in other dividend-paying stocks at good prices. There are several signs to sell a dividend stock, but it all comes down to how well the company manages and uses its cash. If you've invested in dividend-paying firms at the proper price, most of these indications won't matter. Large blue-chip dividend-paying corporations with competent management usually have manageable debt and utilize cash efficiently. These powerful and diverse firms can still expand and pay dividends. However, smaller cap dividend-paying corporations or those in riskier industries may require full use of this list and the dividend coverage ratio. Thanks for watching. If you liked this video or found the information useful, please subscribe to the channel, like, and share the video. I know it's annoying to ask, but it really helps out a small channel. As always, stay safe and take it easy.